One of the interesting developments in global financial markets over the past several weeks has been the sharp rise in long-term interest rates. In Canada, the benchmark 10-year Government of Canada yield has risen more than 50 basis points since early May. The reason for that is largely what's happening south of the border in the United States. The 10-year Treasury yield there has risen slightly more than 50 basis points, so Canada, while selling off, has actually done a little bit better. Now, there are four key reasons why the U.S. bond market has sold off. The first one is probably a good one for stocks and just general optimism, is that growth is better. We had 175,000 jobs created in the latest month, and that was a little bit better than expected. And as a result, consumer confidence remains at the highest it's been for years. Part of that is also due to the record highs we've seen in stock prices and the fact that home prices in the U.S. continue to escalate at double-digit rates. Now, of course, when you do have rising stock prices, a lot of people decide to put more money into the stock market than into the bond market. So that's another reason why bond yields rise. A third reason is that Europe, the crisis there has calmed down a bit. Earlier this year, we had problems in Italy because of uncertain election results. We also had a banking crisis in Cyprus that was threatening to spread all through Europe. Things have now calmed down. Interest rate differentials throughout Europe are now at the lowest they've been since the crisis really began to flare up several years ago. And that's taken a lot of the safe haven flows that normally goes into the U.S. bond market has reversed course. But most importantly, the bond market has been selling off in the U.S. because of worries about the Fed cutting back on its quantitative easing, not buying as much treasuries and mortgage-backed securities as they have. Currently, they're buying $85 billion per month, and the fear is that they're going to pare that back. Fortunately for the Fed, they aren't going to do anything that's going to hurt the U.S. economy. So if interest rates are rising too much because of fears of that, the Fed simply won't do it. And there's other reasons too where I believe that interest rates, when they do rise and continue to rise, it'll be gradual from an historical standpoint. The first one of those is the fact that Europe will likely flare up again as a crisis. We're heading into elections in Germany, very uncertain elections, and that will be a source of uncertainty. We also know that the demand for high quality collateral among banks and financial institutions around the world has risen because of new financial regulations, and treasuries and government Canada bonds are one way in which banks and financial institutions will satisfy that increased demand for high quality collateral. Importantly, inflation in the United States is pushing near record low levels. In Canada as well, inflation remains very low, so bond yields will not rise that much because inflation is very subdued. And also the Fed, the central bank in the United States, is keeping interest rates extremely low. No one expects them to raise rates until 2015, perhaps for another 2 years, with interest rates in the United States near zero levels. And that will keep a bit of an elastic band impact on yields. As the longer-term interest rates rise, they get stretched further and further away from where short-term interest rates are. So interest rates will rise on both sides of the border, but gradually. They'll put a little bit of cooling pressure on the housing market, which is probably not a bad thing. Most importantly, though, it will be reflecting stronger growth, which is good for stocks, even though bond yields will be rising. Overall, I think we'll get a gradual increase in yields. So if you've been a fixed income investor waiting for those yields to rise, I think those higher yields are going to be unfolding in the months and quarters ahead.